iFVGs are currently the most popular concept amongst ICT traders because they are a very powerful array that can signal whether the market is respecting a draw-on liquidity target or whether the market is creating a reversal towards the other direction. And if used correctly, they can provide us with the earliest entry setups with the best risk-to-reward trades from any ICT trading strategy out there. So in this video, we are going to cover what iFVGs are, the criteria we use for finding the highest quality iFVG setups, how we filter the price action to determine whether an iFVG should be used or ignored, along with the most popular entry and stop-loss placement strategies for planning trades with these concepts. So let's waste no time and start with step number 1, which involves learning what an iFVG actually is and how we can use them to find high-probability trades. An iFVG is the abbreviated name for what is called an Inversion Fair Value Gap, which is a PD array that forms when a fair value gap gets disrespected. So let's show an example of how this works. Here we have an example of a bullish fair value gap, which, as we know, would typically be targeted as an area of support. But in the scenario where the market decided to instead push through this area and close below it, this creates what we call an inversion, which essentially means that the FVG has failed and the directional bias of the gap has now flipped. What this means is that the area that we previously would have considered an area of support, we now consider an area of resistance. And this new resistance area that forms is what we call a bearish inversion fair value gap. But one very important piece of criteria we need to make clear is that in order for us to actually confirm that an FVG has transitioned into an iFVG, the candle that disrespects the FVG must actually close past the area of the fair value gap. Even if the candle pushes through the whole area, we cannot confirm the iFVG until the candle has closed. And this is because there is always the chance that the candle is just wicking through the area before creating a strong pullback in the other direction, which of course would mean that this wouldn't have created a valid bearish iFVG. So this covers the basic criteria for how we define a bearish inversion fair value gap, which we will cover further in a moment. But first, let's take a look at its bullish counterpart. Here we have a bearish fair value gap, which, as we know, would be considered an area that the market might target as resistance towards the downside. But through using the same logic, if the market was to disrespect this area by pushing the whole way through it with the candle closing above the area, this creates what we call a bullish inversion fair value gap, which is where the area that we originally would have considered as an area of resistance could now be used as a potential area of support instead. But again, just to be clear, the important criteria for confirming a bullish iFVG is to make sure that the candle that disrespects the bearish fair value gap actually closes above the gap's area, because until it's closed, there always remains the chance that the market could just be wicking through the area before continuing its move lower, which would mean the iFVG was never confirmed. So this small demonstration covers the very basic definitions for how we identify both bullish and bearish iFVGs. But there is a lot more we need to know, including what criteria we look for to define high-probability iFVGs, as well as the best methods for trading them. But before we look further into this, I wanted to quickly mention that we have just released our Smart Money Concepts TradingView Indicator Package, which includes 3 customizable multi-time frame indicators that implements over a dozen different concepts, including the iFVG concepts you'll learn in this video, as well as all of the other concepts we have covered so far on the channel. And for a short time only, we are offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. So check it out at the end of the video once you understand all there is to know about iFVGs, which moves us on to the next step, which involves looking into the most popular trade entry strategies when using iFVGs. By definition, any FVG can technically become an iFVG, but like with FVGs, not every iFVG trade setup is equal in value and quality. And the reason why comes down to the logic behind what an iFVG is actually used for, which is to signal when a potential reversal in the market's order flow might be occurring. And what this means is that the areas that we can expect the highest quality iFVGs to form would be found where the market is most likely to create a strong reversal. And in terms of smart money concepts, this would be during either an attack of a liquidity level or an attack of a high time frame fair value gap. So this is where we should be looking for our iFVG setups. So if we start by taking a look at an example of how we might look for an iFVG setup during an attack of liquidity, we have this piece of a chart here where we see that the market has just pushed through a previous swing high, which in this case was acting as our current draw on liquidity. And another important detail to take note of here is that this bullish move also created a bullish fair value gap, overlapping with the liquidity level. And with this attack of liquidity, along with the creation of the bullish FVG, there are 3 potential outcomes that we can anticipate. The first possible outcome would involve the market just continuing its move up, ignoring any interaction with the fair value gap, and we would just categorize this as a continuation move. But then we have the second outcome, which would involve the market temporarily creating a retracement back down into the bullish fair value gap, where it can then find the bullish supporting strength to create the next leg up. And if this outcome were to happen, it would also be categorized as a continuation move. However, for the third potential outcome, instead of pushing further up, the market instead pushes down, breaking past the liquidity level in the bullish fair value gap that had recently formed. And this is what we call a sweep of liquidity, because the market has attacked the liquidity level but then quickly reversed in direction, disrespecting the bullish PD arrays that could have been used as areas of support to create the next leg. And we categorize this type of move as a signal that a potential reversal in the market's directional order flow might be occurring. But in this scenario, we now know that when the market closed below this bullish fair value gap, it created a new PD array, which is the bearish iFVG. And with the confluence of the iFVG being created during a sweep of liquidity, we can consider this a higher probability iFVG because we now have stop orders being used to fuel the bearish move from traders longing both the failed breakout move and the failed bullish fair value gap. So just to clarify this, the first setup scenario where we would be looking for higher probability iFVG setups is during an attack of a liquidity level. And the most common liquidity levels that most iFVG traders target for setups are either previous day highs and lows or session highs and lows. But realistically, it can be from any liquidity level that could potentially be swept. So to show an example of this, here we have a small portion of a chart which contains the market structure that occurred during the Asian session and the London session, with the New York session having just opened. And if we analyze the market structure of these sessions, the Asian session developed a large range with a distinctive high and low, whereas with the London session, we can see it left a much smaller consolidating range in comparison, which gives us a great example for showing how an AMD session model might play out. And we have already covered the AMD model in depth within our video on candle range theory, but the simplified idea is that if we expect the market to create a bullish rally during the New York session, it might choose to first push down and attack the Asian session low to grab the liquidity sitting below this level, allowing the market makers to fill their buy orders at a good price, before then pushing the market in the real direction they want it to move in, and attacking the low or high of a previous session before reversing in the other direction is a very common scenario that a huge amount of traders base their whole strategies upon. So if we look at this attack of the Asian session low with this potential reversal outcome in mind, one of the ways that we can analyze whether the market is creating a reversal sweep in real time is through the creation of an iFVG. So to show how this setup method works, let's zoom into this 1-hour candle that attacked the Asian low and take a look at its market structure on the 5-minute time frame, where, as we can see, we have a bearish 5-minute fair value gap sitting just above the liquidity level. And at this moment in time, this is a bearish piece of market structure, because this bearish fair value gap can potentially act as the resistance area for creating the next leg down. But if we wait to see what the market actually wants to do, in the instance where the market pushes up and instead decides to disrespect this FVG with the candle closing above its area, we now have a bullish 5-minute iFVG. And it's this bullish PD array that we can use for a long setup, with the thought process behind the trade idea being that this is the first immediate sign that the bearish order flow is failing and could potentially be switching to a bullish bias as a result of sweeping a liquidity level. And in terms of which time frame this kind of iFVG setup can be used on, it can be any time frame because, as we know, time is fractal in trading, so the concepts work the same. For example, if we zoom back out to the 1-hour chart, we can see that we also have a 1-hour bearish fair value gap. And with the same logic, if the market managed to push up and close above this FVG area after the liquidity sweep of the Asian low, this would create a bullish 1-hour iFVG, which would also be a valid PD array for a long setup. But in terms of the advantages and disadvantages between using this 1-hour iFVG or the 5-minute iFVG for an entry, is that this 1-hour iFVG would be considered a stronger PD array to trade from because it was created on the higher time frame. But the trade-off to this is that we would have to wait longer for the market to move up and disrespect the fair value gap that created this 1-hour iFVG, with its positioning on the chart being further away from the liquidity level. Meaning that, whilst you might have a stronger iFVG in terms of time frame hierarchy, the downside is that you would be offered a worse entry price with a larger potential drawdown size if the market were to reverse back the other way against the trade. So this is why you might see different variations of iFVG strategies, with some traders scalping using 1-minute iFVGs, whereas others that are looking for larger market targets will use higher time frame iFVGs. It really all comes down to your trading style and making sure you have a solid risk management strategy. So that covers how iFVGs can be used during an attack of liquidity. But there is also another type of setup that also works great with iFVGs, which is during an attack of a higher time frame fair value gap. So let's take a quick look at that. Here we have a piece of a 1-hour chart that contains a bullish 1-hour fair value gap. But now if we go down to the 15-minute time frame and move forward in time, we can see that a 15-minute bearish fair value gap has formed just above the 1-hour FVG. And this means the market is now sandwiched between two different fair value gaps from opposing biases. But because the bullish fair value gap is from the higher 1-hour time frame, we will prioritize this as the stronger FVG in terms of the directional bias. But still, when the market is sat between two different PD arrays that support opposing narrative biases, it doesn't give a huge amount of confidence in determining what move might happen next. So you might be wise in choosing not to use this particular bullish fair value gap for a long setup. But another way to look at this scenario is that we can also look at this 15-minute bearish fair value gap as a potential bullish setup depending on how the market interacts with it. For example, if the market found support from this 1-hour fair value gap before then creating a bullish move up, if it were to find resistance in the 15-minute bearish FVG, where it just consolidates sideways for a while, this would obviously be the kind of price action you would want to avoid. But on the other hand, if the market instead moved up impulsively from the bullish FVG and closed above the bearish FVG, we would then be left with a bullish 15-minute iFVG. And this is the bullish signal that we could then use for a long setup, because the directional order flow bias has reversed on the lower time frame as a result of the market respecting a higher time frame FVG. So hopefully by looking at this example along with the ones before, it's made clear that iFVGs are used as a confirmation signal that the market has reversed its directional bias based on whether it's respecting or disrespecting FVGs. But the most important aspect is understanding which FVGs should actually be considered for these signals, which is why we only really want to be using iFVG setups at areas in the chart that contain a high volume of liquidity where we suspect a reversal move could potentially occur, which is either during an attack of a liquidity level or during the attack of a higher time frame FVG. So now that we understand why we should only really be targeting iFVGs that form at key reversal areas in the market, let's now move on to the next step, which involves understanding how the difference between an impulsive move or a consolidation move can determine whether an iFVG would be considered high probability. When we talk about consolidation and impulsive moves in the context of creating iFVGs, we are referring to the strength of the move that disrespects the original fair value gap, which resulted in the creation of the iFVG. And the reason why this is important is because depending on how the market chooses to disrespect a fair value gap, it can provide a good insight into whether we should actually consider the move a true reversal or whether it's just a moment of indecision in the market. So to show what we mean by this, we will use this small piece of price action here which contains a bullish fair value gap. And all we are going to do is move forward in time to see how the price action plays out, which, after a little while, managed to close below the fair value gap. And if we are to go by pure definition, this move would have technically created a bearish iFVG after closing below the bullish FVG. But one of the most important fundamentals in trading is the ability to assess the behavior of how a market is moving. And in this case, whilst the market did manage to close below the FVG, it only managed to do so after a long series of candles with very little volatility, which suggests there is either no volume in this move or that the market is simply indecisive on which direction it wishes to move in. And as a trader, this is the kind of consolidating price action that we want to avoid, because the market is just not giving us the ideal reaction we are looking for. But on the other hand, if we look at another example of how the market could have disrespected this fair value gap, this time we see a strong bearish candle breaking down with a lot of volume. And this is what we would call an impulsive move, because we are seeing a clear sign of which direction the market intends to move in, with no sign of indecision or weakness. So it's this type of strong rejection move that we want for when deciding whether an iFVG is offering a tradable setup. And with the information of the two steps we've covered so far, we now know where on the chart we should be looking for iFVG setups, as well as the ideal invalidation move that we look for that makes an iFVG higher probability. But we have yet to cover the different ways we can trade them, which moves us on to the next step, which covers the most popular trade entry and stop-loss placement strategies that traders use with iFVGs. When it comes to iFVGs, there are two different potential outcomes that we can anticipate from the market's price action, while still respecting the iFVG. The first outcome would involve the market simply continuing the move further in the reversal direction, without creating a retracement back into the iFVG. And this would show that the market reversal is so strong that it doesn't even need to return back to the iFVG for the extra volume needed to continue the move down. But as for the second outcome, this time we see that the market does retrace back up and into the iFVG area. And the purpose behind this is for the market to target those unfilled orders within the area, which it can then use as the extra strength it needs to make the next push down. But remember, if the market attacks an iFVG and it was to push the whole way through it with the candle closing above it, we would consider the iFVG invalidated, meaning that it more than likely won't hold, with the market continuing to move in the other direction. So in terms of the two potential outcomes we have shown here, we are speaking in the context of the iFVG actually being respected as an area of support or resistance. But with the understanding that an iFVG setup can play out without the iFVG actually being touched, it leads to there being two different entry models that each hold their own advantages and disadvantages. For the first entry model, a trader would enter a trade immediately after the iFVG has been created, with the crucial criteria here being that the candle that disrespected the FVG actually closed past the FVG area. And this entry model is considered the more riskier model of the two, but also the more popular amongst traders. The reason being is that entering upon the close of the disrespecting candle that formed the iFVG makes sure that you never miss a potential iFVG setup. And this is because with the information we just covered a moment ago, we know that the market doesn't always retrace back into the iFVG to create the next rejection. Sometimes it just simply continues moving without any pullbacks. And then, in terms of the most common stop-loss placements, the first option is just above the iFVG's area, with the idea that if the market was to reach this price, it would mean that the iFVG has been invalidated, which in turn invalidates the idea behind the trade setup. But there is also another option, which involves placing the stop-loss just above the most recent high. And the reasoning for this would be to protect against the market quickly wicking through the iFVG before it found the resistance for the next rejection, which is a scenario that is quite common with both iFVGs and normal FVGs. And then we have the other popular entry model, which involves placing an order at the edge of the iFVG and waiting for a retracement. And this is the more conservative approach because it involves waiting for the better trade entry, which of course offers a higher risk to reward ratio for your trade. But the downside that puts a lot of traders off from using this model is that it can mean you miss trades in the scenarios where the market chooses not to retest the iFVG and instead continues the reversal move without a pullback. So what this all means is that depending on your own personal trading style and risk management strategy, there are some small but significant variations you can choose between when trading iFVG setups. And if you think these concepts would work well within your trading strategy, we have developed a series of powerful ICT TradingView indicators that implement the logic of everything you've learned in this video, along with all of the other concepts we have already covered on our channel. And for a short time only, we are offering a 7-day trial period where you can test the indicators out for completely free, which can be found through the link in the description. And if you found this video helpful, please leave a like and a hype, and comment which ICT concept you'd like to see us cover next. And if you haven't watched it already, you really need to click the video on the screen that covers order flow legs, which is a concept that combines FVGs and iFVGs with immediate liquidity targets for both scenarios, all in one concept.